Ladies and gentlemen, pay attention, because moments like this don't announce themselves quietly. They arrive disguised as rule changes, buried in fine print, and explained away as risk management. But let me ask you a powerful question right now. When the rules change in the middle of the game, who are they really protecting? Today, we're talking about a shockwave that just hit the silver market. CME changed the margin rules, and in doing so, sent a clear message to anyone who's been watching closely. The CME's sudden decision to raise margin requirements on silver contracts has sent a clear and immediate signal through global markets, catching traders, analysts, and institutional participants off guard. Margin changes are not routine housekeeping measures. They are powerful tools used only when volatility, risk exposure, or price momentum begins to move beyond what an exchange considers comfortable. The timing of this move is what has raised eyebrows across the financial world because it did not follow a market collapse or a liquidity crisis. It arrived during strength, momentum, and growing confidence in silver, which makes the action impossible to ignore. When an exchange like the CME increases margins, it effectively raises the cost of participation. Traders are required to post significantly more capital just to maintain existing positions. This immediately pressures leveraged participants, particularly short-term traders and funds operating on thin capital buffers. The first hook here is simple but critical. If the market was truly stable and risk was truly contained, there would be no urgency to make trading more expensive overnight. Exchanges do not disrupt active markets unless they believe something bigger is forming beneath the surface. The speed of the decision is just as telling as the decision itself. Sudden margin hikes often occur when price action accelerates faster than risk models anticipate. In silver's case, rising open interest, expanding volume, and sustained upward price movement created conditions that challenged existing assumptions. Rather than allowing the market to continue testing higher levels naturally, the rule change acted as a brake, forcing traders to either inject more capital or exit positions. That raises an uncomfortable but necessary question. Was this about protecting the system or controlling the outcome? Another compelling hook lies in historical context. Similar margin increases have appeared during major commodity rallies in the past, often right when bullish sentiment begins to solidify. The pattern is familiar to seasoned market observers. When confidence spreads and participation grows, the rules tighten. That doesn't invalidate the move in silver. It highlights its growing relevance. Markets do not receive this level of attention unless they matter. What makes this moment particularly engaging is what it reveals about silver's position in the broader financial ecosystem. A market that can trigger immediate policy responses from a major exchange is not a fringe asset. It is a market gaining influence, attracting capital, and challenging expectations. The margin hike may slow momentum temporarily, but it also confirms one undeniable reality. Silver has reached a point where it can no longer be ignored. Market participants have been quick to interpret the CME's margin increase not merely as a technical adjustment, but as a deliberate attempt to regain control over a market that was beginning to move on its own terms. This interpretation gains strength when you look beyond the official language of risk management and focus instead on timing, impact, and historical behavior. The hook here is unavoidable. Control measures are rarely deployed when markets are calm, predictable, and compliant. They appear when price action starts to challenge established expectations. By raising margins, the CME didn't change the direction of silver directly. It changed who could afford to stay in the game. That distinction matters. Higher margins disproportionately affect leveraged traders, momentum-driven funds, and speculative positions that amplify price movement. When these players are forced to reduce exposure or exit entirely, momentum slows, volatility contracts, and price discovery becomes constrained. This is not accidental. It is a mechanical way to cool enthusiasm without ever touching the price itself. Ask yourself this: if price discovery is truly free, why intervene at the participation level? The perception of market control is reinforced by the asymmetry of the response. Margin hikes rarely impact large, well-capitalized institutions in the same way they affect smaller participants. The result is a narrowing of influence where fewer players hold more control over price movement. This creates a temporary illusion of stability while masking the underlying demand that was driving the move in the first place. The hook here is subtle but powerful. Slowing a market does not eliminate demand, it only delays its expression. There is also a psychological dimension to this move that cannot be ignored. Rule changes introduce uncertainty, and uncertainty weakens conviction. Traders begin to second-guess positions, reassess risk, and pull back not because fundamentals changed, but because the environment did. That hesitation alone can achieve what outright selling cannot. When confidence is interrupted, momentum fractures. That is market control at its most efficient, quiet, procedural, and defensible. What makes this interpretation resonate so strongly is precedent. Similar actions have been taken during periods when commodities approached levels that threatened entrenched positioning or structural imbalances. Each time, the justification sounded reasonable, even responsible, yet each time the effect was the same. Enthusiasm was capped, participation was reduced, and the pace of price advancement was restrained. The real hook is this realization. Control is most effective when it looks like policy, not interference. The growing focus on the $85 silver narrative has shifted from being a fringe talking point to a subject of serious market discussion, and that shift alone explains why attention has intensified so rapidly. Price targets do not unsettle institutions simply because they are ambitious. They do so because they are increasingly plausible. The hook is this: markets don't react to fantasies. They react to probabilities. As silver began to demonstrate sustained strength, tightening supply dynamics, and expanding investor participation, higher price projections stopped sounding speculative and started sounding uncomfortable. What makes the $85 level particularly significant is not the number itself, but what it represents structurally. At that range, silver is no longer behaving like a forgotten industrial metal or a secondary precious asset. It begins to challenge valuation frameworks, hedging strategies, and legacy positioning that were built around far lower price assumptions. That is where institutional unease emerges. When long-held models start to break, confidence in control weakens, and the response is rarely passive. Ask yourself this: if higher silver prices posed no systemic issue, why would the narrative suddenly attract so much resistance? The attention surrounding this price target has also been amplified by visible changes in market behavior. Rising open interest, increased options activity, and persistent physical demand have all contributed to a feedback loop where belief reinforces participation. That belief is powerful. It turns price targets into self-fulfilling pressure points. The hook here is psychological. Once enough participants believe a level is achievable, markets begin moving toward it not out of hype, but out of positioning. Institutional players are acutely sensitive to this kind of momentum. Unlike retail participants, they must manage exposure across portfolios, counterparties, and balance sheets. A rapidly appreciating silver price introduces complications in hedging costs, delivery obligations, and liquidity planning. The higher the projected price, the greater the strain on existing structures. This is where concern replaces complacency, not because silver is rising, but because it is rising in a way that defies traditional containment. What elevates the $85 narrative beyond speculation is the reaction it provokes. Strong reactions rarely emerge without credible risk. Dismissed ideas are ignored, threatening ones are addressed. The sudden urgency to slow enthusiasm suggests that higher silver prices are no longer hypothetical scenarios discussed in isolation, but outcomes being actively modeled behind closed doors. That is the real hook. When a price target starts influencing policy decisions, it has already crossed the line from imagination into relevance. The growing attention around $85 silver is not about excitement alone. It is about exposure, accountability, and the quiet acknowledgement that the market may be preparing for a reality many are not positioned to handle. The likelihood of forced liquidations following the margin increase is one of the most immediate and consequential outcomes the market must confront. When margin requirements rise sharply, the impact is not theoretical, it is mechanical, and unavoidable. Traders who were previously compliant suddenly find themselves undercapitalized, and the clock starts ticking. Either additional capital is posted or positions are reduced or closed. The hook here is stark. Markets don't wait for opinions when margin calls arrive. They demand action. Forced liquidations rarely reflect a change in conviction or fundamentals. They are the result of arithmetic. A trader may still believe in the upside of silver, may still be aligned with the broader trend, but belief does not satisfy margin requirements. This creates a distortion where selling pressure emerges not from weakness in the market, but from constraints imposed on participation. That distinction is critical because it means price can temporarily move against the underlying reality of supply, demand, and long-term positioning. The most vulnerable participants are those using leverage to amplify returns. Leverage magnifies gains, but it also magnifies sensitivity to rule changes. When margins increase, leverage contracts instantly. Positions that were once sustainable become liabilities overnight. The hook here is uncomfortable, but true. Many exits during these periods are not strategic decisions. They are forced responses. This is how momentum stalls without any fundamental trigger. There's also a cascading effect that often goes unnoticed at first. One liquidation leads to another as prices dip, stops are triggered, and risk managers step in. What begins as isolated selling can briefly resemble a broader breakdown, even though the original cause was structural, not market-driven. This is where experienced observers separate signal from noise. Forced liquidations create volatility, but volatility under constraint is not the same as a reversal of trend. Another layer of complexity lies in who is least affected. Well-capitalized institutions can absorb higher margin requirements with relative ease, allowing them to maintain or even expand positions while others are pushed out. This reshapes market participation, concentrating influence among fewer players. The hook here is subtle but powerful. Forced liquidations don't just move price, they redistribute control. What makes this dynamic especially compelling is its predictability. Margin hikes have repeatedly produced short-term sell-offs followed by stabilization once weaker hands are cleared. The selling pressure exhausts itself because it is finite. There are only so many positions that must be closed. And once that process runs its course, the market is left with participants who can withstand higher requirements and longer timelines. Forced liquidations may slow silver's advance in the near term, but they do not erase demand, alter supply, or invalidate the forces that drove prices higher in the first place. They simply test, resolve, expose fragility, and remind everyone that in leveraged markets, rules can matter as much as conviction. There are risks. This strategy is far from unprecedented, and that historical consistency is exactly why many seasoned observers immediately recognize the margin increase as part of a familiar playbook when commodities enter strong rallies, especially those driven by broad participation and accelerating momentum. Exchanges have repeatedly stepped in with tighter rules under the banner of prudence. The hook here is simple but revealing. If these measures appear again and again at similar moments, they stop looking reactive and start looking intentional. Looking back across decades of commodity markets, margin increases have often surfaced at points where enthusiasm begins to harden into conviction. Silver, oil, and other raw materials have all experienced this pattern. As prices rise steadily, skepticism fades, participation widens, and the narrative shifts from maybe to inevitable. That is usually when the environment changes. The rules don't break rallies at their weakest points. They intervene when strength becomes difficult to dismiss, and ask yourself why intervention so rarely happens during prolonged declines. What makes this strategy effective is that it operates quietly within accepted frameworks. Exchanges are granted broad authority to manage risk, and margin adjustments fall squarely within that mandate. There's no need for dramatic announcements or overt interference. A technical update achieves the desired effect while appearing neutral and responsible. That's the hook most people miss. Control is most powerful when it hides behind procedure. History also shows that these measures tend to impact perception as much as price. When margins rise, headlines shift, confidence turns cautious, commentators begin emphasizing risk rather than opportunity. This reframing alone can cool participation, even among those not directly affected by higher requirements. Momentum thrives on belief, and belief is sensitive to atmosphere. Changing the rules changes the mood, and changing the mood changes behavior. Another recurring element is timing relative to visibility. Margin hikes often arrive when public attention increases and participation broadens beyond specialized traders as markets attract more eyes. Controlling volatility becomes a higher priority for institutions responsible for maintaining orderly trading. The hook here is subtle. The more democratic a rally becomes, the more pressure there is to rein it in. Yet history also reveals something equally important. These interventions rarely eliminate the underlying forces driving price. They interrupt, delay, and redistribute, but they do not reverse long-term trends rooted in supply constraints, structural demand, or monetary conditions. In many past cases, once markets adjusted to new requirements and weaker positions were flushed out, price action resumed its broader trajectory. The repetition of this strategy is what gives it weight. Patterns persist because they work, and when the same response appears at similar inflection points across time, it sends a clear message to those paying attention. This is not an anomaly. It is a reminder that in powerful rallies, the most meaningful resistance often comes not from the market itself, but from the rules governing it. For many long-term investors, the aggressive response to silver's momentum is not being interpreted as a warning sign, but as a form of validation. That perspective may seem counterintuitive at first. Yet it rests on a simple and powerful hook. Markets do not defend against what they consider irrelevant. When an exchange takes decisive action, it signals that the asset in question has reached a level of importance that demands attention and management. From this viewpoint, the margin increase is less about fear of collapse and more about acknowledgement of influence. Long-term investors tend to focus on structural forces rather than short-term price fluctuations, and what they see is a market capable of generating enough pressure to require intervention. That alone reframes the narrative. If silver were truly weak, overvalued, or disconnected from fundamentals, there would be little need to act. The hook here is clarity. Strong reactions reveal strong underlying dynamics. There is also an important distinction between volatility and fragility. Short-term traders often equate sudden rule changes with instability, but seasoned investors understand that volatility frequently accompanies transitions in market perception. As an asset moves from neglect to relevance, resistance increases. That resistance can come in many forms, including regulatory or procedural adjustments. For those with longer time horizons, this is not discouraging. It is familiar territory. Another reason the move is seen as validation lies in the asymmetry of effort. Increasing margins is not a casual decision. It requires analysis, justification, and acceptance of potential backlash. Institutions do not invite controversy unless the perceived risk of inaction is greater than the discomfort of action. That calculation alone suggests silver's trajectory was becoming difficult to dismiss. The hook is subtle but compelling. When effort increases, so does perceived significance. Long-term investors also recognize that interventions often occur near inflection points, not endpoints. Markets that are genuinely exhausted tend to roll over quietly. Markets that are challenged externally often do so while demand remains intact. The margin hike did not change industrial usage, physical demand, or macroeconomic drivers. It changed the trading environment for investors focused on fundamentals. That distinction reinforces confidence rather than undermines it. Perhaps most importantly, this response sharpens focus. It separates transient participants from committed capital. When the cost of participation rises, only those with conviction and capacity remain. That winnowing process can strengthen a market's foundation over time. The hook here is endurance. Assets that survive pressure often emerge more resilient. Viewed through this lens, the market reaction is not a verdict against silver's future, but an acknowledgement of its growing weight in the financial system. For those thinking in years rather than weeks, that acknowledgement carries more significance than any temporary pullback ever could. So let me leave you with this. Don't be distracted by the noise of rule changes. Focus on the signal behind them. And when the system shows its fear, that's your insight. When the rules change, that's your education. And when pressure rises, that's where transformation begins. Stay sharp, stay disciplined, stay awake. Because history doesn't remember those who panicked when the rules changed. It remembers those who understood why they did. But